Capital growth is great. It is what all property investors hope to achieve, but growth is often coupled with a big capital gain tax bill, unless you know how to qualify for an exemption. Hi, I'm Krishan Sharma, founder and director of KNS Accountants. As a team, our goal is to provide you with the necessary information to understand your financial position and make the best decision for your business. Look, tax is often an inevitable fit of owning an investment property in Australia. And it is not uncommon to hear that investor gets completely overwhelmed at the thought of potentially having to pay thousands of dollars in tax on their hard-earned investment profit. However, there are few lucrative tax exemptions and concessions that you can use to minimize your investment value. So in today's video, I'm going to help you navigate capital gain tax and how to minimize it. This way, you will be prepared when it comes time to sell your investment property. Before we get into it, it is important to note that information is intended as a guide only. It should not be seen to constitute legal or tax advice. You should, where necessary, seek your own advice for any legal or tax issues raised in your business affairs. Let's start with what capital gain tax entails. According to the ATO, if you make a profit on the sale of your investment property, the profit is considered a capital gains and must be declared on your income tax return. The additional tax you have to pay after including capital gains on your tax return is known as capital gain tax or CGT. Thankfully, the ATO does allow property investors to be exempted from paying capital gain tax in certain circumstances. The four main exemptions and concessions include the main residence exemptions, the CGT 6-year rule, the 6 months rule, and the 50% CGT discount. The first exemptions relates to owner-occupiers. As a general rule, the home you principally live in is exempt from capital gains. This is because you don't generate an income from living in your own home. You will have to meet few requirements though. You must live in the property, store your belongings there, receive your personal postal mail to that address, have the address recorded as your home on the electoral roll, and receive the utilities in your name. The second concession is known as the CGT 6-year rule. Essentially, this concession allows you to use your main residence as an investment for a period up to 6 years. In other words, you can use your investment property as if it was your main residence for a period of 6 years and still rent it out. So if you sell the property within the 6 years, you won't have to pay capital gain tax. Third on the list of exemptions and concession is the 6-month rule. This concession is helpful if you have bought a new home and have not been able to sell your old property. Essentially, you're allowed to hold both properties as your main residence for up to 6 months so that you have some time to dispose the old property without triggering CGT liability. And lastly, if you do not qualify for either of the three exemptions, the ATO still offers you a way to reduce the amount of CGT you pay significantly. If you have owned your investment property for at least 12 months before selling it, you will be allowed to claim a 50% discount on your capital gain tax. So if you are thinking of selling your investment property, make sure to maximize its value by taking advantage of one or more of these exemptions and concessions that allow you to minimize the amount of CGT you have to pay. If you have any questions relating to capital gain tax and how it is calculated, or if you just want to know whether you qualify for one of the exemptions, we would love to hear from you in the comments. Otherwise, make sure to subscribe for more videos on accounting information relating to your business or investments. See you next time.